Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, May 22nd, 2020. It's almost 10:30 Eastern Time as I'm starting the video, so we're about an hour into the trading day, and I just wanted to go over just a quick update on the markets and update on a few recent trade ideas, as well as a new one to throw in there as well. So it'll be a relatively quick video. SPY, the big levels to watch, or bigger picture. We get down to the micro levels, a little more granular when we drill down to the 60-minute charts, which I've been posting a lot lately. But bigger picture is this: the SPY continues to flirt with the 200-day exponential moving average. It's the red line right here. We failed at the first attempt once we took it out. Remember, we took it out back here, went through, popped above it, which is normal to get a brief overshoot. Traded above it for a couple days, couldn't hold that, and we were rejected. So come back, boom, 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 multiple tests. Say what you want about it, but it's hard to argue that that's not a technically significant level. And again, we have the 200-day simple moving average just above it in blue. So we're still, that's the story of the last week or so here. We're sandwiched between. We gapped up Monday. And pretty much traded either on or just below or just above that level. So for all intents and purposes, we're still testing it. It doesn't, you have a big price swings in the market. If you're a little bit above it, a percentage point or two, or a percent or so below it, no big deal. But what you want to watch for here is, bulls want to put that level, and of course the 200-day simple just above, they want to put that in the rear view mirror. A solid break and sustained move above there, and the bears, at least for the bearish case, I'm speaking metaphorically here, of course, sellers, short sellers, or just the market in general. You get the bearish case, you need to see a move back down below it, especially now that it's been regained like it was here, because if you move below it, then that would mean we had a false breakout whipsaw signal. And again, if we close today a hair below it, is that a big deal? No. But if we do backfill the gap, and that's what I was talking about this morning, here's that big gap where we closed on Friday and we gapped up Monday, and so therefore, if that gap is to be filled, then that's going to put us solidly back below it. Now we've already, we were rejected here and we moved below, but what happened is we hadn't taken it out. These were failures at the 200. We took it out recently. So again, that would certainly help the bearish case, but it's, there's still plenty of support in the markets, and in the bigger picture, really, to firm up the case for a much larger drop, you have to just take out the bottom of this recent trading range we've been grinding around in for last almost 2 months now. It's been well over a month. So that's kind of the bigger picture. We drilled down to the 60-minute charts, look at the more near-term picture. Let's look at this board here. It's a little clearer, the 295 level. So you have these series of, your larger uptrend line we broke down, whereas that, could have and might have had the potential for a much bigger drop. Instead, we've just traded sideways since then. And this can be spun one of two ways. It can be viewed as healthy consolidation. I often talk about how stocks can correct in one of two ways. They can correct in price, which most people are familiar with, a correction, but they can also correct in time. Break down from a bearish chart pattern, and you can correct in time. You work off the overbought conditions, the near-term overbought from this big run up off the bottom, and then power back up. Then again, I've seen, you're in a trading range. Yeah, it can break either way. We could still, even though we've been correcting largely in time, we could have another leg down. And this is, at the very least, the other day we had some near-term sell signals when we broke these the most recent minor uptrend lines. Just like we had this one back here, broke it, kind of nothing big for the first two candles, and then boom, finally started to move down impulsively there. So that's what I'm looking at, and still favor, as I said this morning. 295 was a fairly significant, not a huge resistance level, but we had a previous reaction high here from the 29th of April. We briefly popped it just like the 200, and we're back below it now. So this is also a failed breakout so far of this level here. And we tried for a while, tried at it, finally took it out right here recently, traded above there for a little bit, and we're back down below it. nothing big yet, not impulsive, and that's what you want to look for. If you want to, ideally, obviously me being short, I want to see an impulsive drop today. I want to see kind of the bulls give up and realize, hey, we failed to take the 200, we failed to take out that level, and then just kind of give in and see a backfill the gap. That would be the ideal scenario. We don't always get what we want. What if things go the other way? Well, like I said in this morning in the update with the static charts, any marginal new high, and when I say marginal, it just means slight. If we go up, 5, 6, 7% from here in the next week or two, that's not marginal. That's not a slight new high. So a marginal new high would still keep the divergences intact, and really it's not going to change much. It's still going to, when you go back to the the daily chart, any marginal new high soon will still have us in very close proximity to the 200-day exponential moving average, and we'd have to, if we rally up, let's say I'm going to the 200-day simple, that's 1.6% above. So that would also constitute a marginal new high. So that's it. When you're in a choppy sideways range, try not to take too much into any one thing, but those are things to look for. And what would be bullish would be just a powerful move up through here, big green candle and some follow through, and just to put those levels in the rearview mirror. Where flip it around the other way, big rejection here, rejection ultimately followed by impulsive selling, and like I like to say, the redder the better. And then finally, ultimately, a break below the recent trading range there around 274. So. All right, so that's what the indexes look like, and so we still are on these near-term sell signals for now. We broke down and we're kind of moving lower, nothing impulsive yet, but that's what I'm looking for. And on the Qs, same story. Here's our board we're working off of. Same thing as SPY. You have these little, we had the bigger trend line off the lows. We broke it. Made a new high, but then broke that minor trend line, had a little correction, set up with another minor trend line, and each of these being divergent highs, and each of those divergent highs followed by little corrections, although these four are really they're four consecutive divergences, really making one larger divergence. So that's what, despite what seems like a bulletproof trend recently, and for the most part it has been, these corrections are relatively minor, that does open up, or I should say increase the odds for a substantial move down. Whether we get it or not, sometimes these divergences get burned through, but as long as they're there, which they are, and the market is at pretty significant resistance, especially the broad market, then the potential exists for a pretty big drop. And I guess what I would just say is, be ready. Don't fall asleep at the wheel. That's one thing I learned over the years. You tend to become kind of complacent and you give up after the markets, whether you're a bull or a bear, long or short, when the market's been grinding around. And sometimes from those periods of those tight trading ranges come some pretty big moves, and it could go either way. But I already, you guys know which way I think it goes. All right, NQ said this morning that was a potential uptrend trend line, because there weren't a lot of tags. That's what makes a potential. Not very few reactions on it. You could also come here off that high. You have to exclude that little pop. Here's another potential. But what is clear are these resistance levels. We were at that 93.49 level earlier this morning. We popped above it. Next price resistance is about 94.15, just a hair above on NQ. And if you're wondering why those levels are there, I mean, they were there for at least last week or so on this chart, or this week. But there it is, a couple reactions there. We broke above it. That was a breakout right there, and then we pulled back tested numerous occasions, could not hold. So this in itself was a failed breakout. Not a huge breakout, again, short-term stuff, but a breakout nonetheless that then failed, and resistance once, or support once broken becomes resistance, and it was there. And again, if we test it from below, so that's it. There's one of our, we've seen quite a few of these lately. Potential head and shoulders, again, potential work to be done. This would have a downward sloping neckline. This would be your left shoulder sometimes, and it's perfectly normal if you look up these patterns to have two shoulders on one side. You call those, especially if you get two on both sides, it's called a complex head and shoulders pattern. Sometimes you can even have two heads. But for the most part, this is the essence of the pattern. There's a left shoulder here or two left shoulders, a head up here, and this is your neckline. And it's only a potential pattern. Why? Because you don't have a right shoulder yet. You have the makings of what could form. If we reverse here, maybe turn out to be a right shoulder, maybe even get a second right shoulder. And then even then, at that point, you'd have a confirmed pattern, but that's still a bearish chart pattern pending a breakdown. And a breakdown of a sell signal on a head and shoulders comes on a break below the neckline. So that's one, just a potential pattern. We'll continue to monitor it. If we move up much higher, we no longer have symmetry, with the shoulders being roughly equal. They don't have to be perfect, but that's something to watch for there. And finally, the S&P 500 futures, kind of sloppy and choppy lately. So like I said, I've been saying this lately, it's probably not a bad time, especially for non-active traders. Take a little time off. The market's not going anywhere. Bigger picture, it's been chopping around. We're zoomed in real tight. This is only a 1 month view of hourly candles, but lately this is it. And again, this is a shorter term look at that battle between the bulls and the bears. Out on the daily chart, battling those 200-day moving average, 61.8 Fibonacci retracement level on the S&P 500 of the previous big drop down into the March lows, and all that good stuff. Okay, now let's get to some trade ideas. Again, when the market's going to grind around, it's like you could try to squeeze water from a rock, blood from a stone. In other words, try to extract money swing trade in the broad market now. If you're a very active trader, there's these little micro levels you can day trade on the futures, leverage up and make it worth your while to get 1% here or there, 2%. But the easier money right now is made on individual stocks, sectors, commodities. Here's one shared by a member of the site. This is from member Becky. Becky said she stumbled upon DKNG the other day. Nice upward channel. PPO finally seems to be crossing over. Heavily overbought and about no support below for 33% all the way down to the 18 level. And that's actually agreed. I've marked the chart up myself with what I would see as targets. Now, what I said is, you have a trend line. You don't have any sell signals. Bearish PPO crossover can be. Sometimes that's it, and you get a decent correction. And then sometimes you do that, you get the crossover, and then you go on, you put a lower low, you might get a divergent high. So we'll watch this one. I mean, this one could, bottom line, whether it breaks down today, next week, or next month, that trend line is valid. I set a price alert, but I often talk about this. On a daily chart, what you want to see is either very impulsive move or a daily close. It is not uncommon to see what we've had so far today. That's a whipsaw signal. In the opening bell, this stock doesn't have a lot of trading history. Pop down and open, but they recovered that level. So that is, it's not a confirmed sell signal. We're right on the trend line. We could get one. I could tell you what would probably do it right now. If you don't want to wait for a daily close, you maybe want to jump the gun, get in at least a half position, if not a full position early, would be a break of today's lows, because now you have yesterday's low, kiss the trend line and bounce. Today we pierced it intra-period so far. Again, this is a daily candle. It won't be finalized till 4 p.m. today. But we hit that low, so now we have a couple reactions here. So that 2760 is a level. I'm going to set a price alert, and I just might short this sucker here. Doesn't have a lot of trading history. I won't put it as an official trade right now. Pass it along, and then you can see the targets here. Plenty of meat on the bone if it hits that one. Drop down to 25-ish, 23, 40-ish, and then maybe all the way down here to a little bit above $18. So again, it's in an uptrend. Make no mistake about it. Overbought is not a sell signal. Something to note, you become overbought, that's usually where you get corrections. But the problem with overbought is it can stay overbought for an extended period of time. So if you shorted overbought here, well, guess what happened to you? You by the time the stock finally corrected, what it took is a series of overbought conditions, and finally we started to diverge. These were about equal highs in the RSI, and then you had this negative divergence that formed. You had divergent high number 1 there, little correction. We continued up, extended the divergence, then the big drop came. And the big drop was in this stock in just a matter of less than 2 weeks, 8 calendar days, 6 trading sessions, that stock dropped about 46%. So it kind of shows you what this one can do. And of course, that was during the big downdraft into the March lows. So I'm not expecting that again, but anything's possible. All right, let's move on. Netflix, we already have. I'll just update it since it's a recently updated trade. We shorted this one yesterday. The breakdown looks legit. We have follow through today with it's interesting to note that QQQ right now is flat. It's up down 0.02%, which is effectively flat, and Netflix is still a big holding in the Qs, and it is down, and that's showing relative weakness. Relative weakness is, you can have a stock up. Let's just say Netflix was up a quarter point today, but the Nasdaq was up 3%. That's still relative weakness. It's weaker than its index, and that's a good sign if you're short. You want to short stocks that are showing relative weakness, or be short stocks that are showing relative weakness. And on the 60-minute chart, I said after the breakdown we had this minor, or this, no, not minor, it's a 60-minute trend line break, impulsive move down, set up into what may prove to be a bear flag. It's getting a little bit stretched. Need to see this one break down soon. That would be the ideal scenario. We have a pretty impulsive red candle, but we need to clearly move down below this flag, particularly yesterday's lows right there, and that should do the trick to get us down to my first target here at 419.85. Will it be hit today like I suspected it might yesterday? Well, not until unless the Nasdaq rolls over again. Let's go back to the futures here. Where did I have my NQ chart? I think I already covered this. So there's a potential reaction at this downtrend line resistance. So I suspect if the Nasdaq does this today at some point, these are the NQ futures, then Netflix will do that as well. We'll have a breakdown there, and maybe a relatively quick hit of that first target. And if it doesn't happen, or it doesn't happen today, 447.22 is resistance. So ideally for this short trade, you don't want it to go back above there. Stop is, I had the stop on the original chart. I need to add it to this one. I drew it in after the fact on the screen draw software. It's somewhere up there, not too far above the highs. I want to update silver because there was under one of the recent trade idea videos where I covered silver. A couple of the members had mentioned taking profits. They were long. It's been a nice run in silver. If you're new to the site or just catching up, back here I highlighted this both bullish setups in gold and silver, and breakouts. There was a little falling wedge with a breakout and a back test right there, and from there. At the time I said I suspected silver would probably outperform gold on this rally, and it did. It was substantial. It was about a 21% run from the back test point right there. So I think for the time being it's probably come full circle. Got a little bit overbought. Negative divergence. Same reasoning in reverse for looking for a rally and being bullish back here is the positive divergence back there. There's your bullish divergence at that point, and this is that in reverse. You just flip the charts upside down. Negative divergence is bearish divergence, and so far you had a little trend line break. We went down. We hit that 17,258 target right there. Hit it a couple times. Boom, boom. And we bounce now. So I suspect where I'm going with this is 1773-ish right there was a support level, which was taken out. Support once broken becomes resistance. This trend line here is just a potential trend line because we only have 2 confirmed reactions. If we get a reversal here, which I favor because that is price resistance, that'll give us that third confirming reaction, and therefore going forward that might be a downtrend line to watch in trade off of. What I mean by that, well, if you're short, you can reshort, it pops up to that level, or set a stop just above it. Again, if it becomes validated. If we happen to pop 17,736 today, next resistance is at 17,996, and anything much more than that means that's it. That's the only correction we get there. So I guess I can tell you this now. It's objective to short here, but I would keep stops relatively tight, and not much more than anything above over that 17, a little bit above, 17,996. Allow for a little enough to avoid a little stop pop. Stop pop is where if that's resistance, they know that all the stops or majority of stops will be set just above it, just like right here. So it's not uncommon to see a little pop clearing the stops and then silver to go on. So if you were to short here, that would be, we've already hit this level. You could target another pullback to 17,258, but being that it's already been tested a couple times, I suspect that we'll break it if we get even close to it again. So my preference would be to just trail stops down again even if we get that reversal here, and then target either or both of those, next targets down there. And again, if you are short this one, didn't take profits yet, you can either have a stop not too far above where we are right now, or a stop not too far above there. You have the previous highs there as well, but again, if you're shorted here, you're just back to where you started, and no reason to get back, off full profits on this trade at this point. And sometimes I forget. I know a lot of traders don't trade the futures. I'll trade the metals. I don't have my chart of silver marked up too much. I can sit here and play around, draw some lines. But let me just give you targets. This is a kind of a big resistance zone right here. A lot of resistance. Silver got into the bottom of that resistance zone, and if it can, continue to push up through here, I think it's going to have some work ahead of it. I don't think it's just going to explode to the top of that zone. Anything is possible, but a failure back out of it would be bearish, and if so, let me give you some pullback targets. Even if I were to trade SLV instead of SI, usually I'll trade the futures contracts. I would watch what's going on. I would watch those levels I just showed you on the futures. And you might say, well, Randy, I don't have a futures account. Well, TD Ameritrade will give you, if you have an account there, which used to be Scottrade, they were absorbed by TD Ameritrade. Their Thinkorswim platform will give you free quotes on the futures, most of them, and I think they have silver. Investing.com gives you free real-time quotes on futures as well. It's free to access. I recommend creating an account there so you can save a little watch list and quickly reference those. You can set up your charts, configure them as you want with your indicators and all that, and then save that in your settings. That way you log back in, you can create a little watch list. I have one for precious metals, I have another one for commodities and all that. It's a useful platform. I'm not using that here, but I'm just showing you that's an idea. All right, levels. So in conjunction with those target and support levels on silver futures, traders like they love these gaps, and they're a lot of traders trade SLV. It's a very liquid, popular traded ETF, just like its counterpart GLD for gold. So I'm putting lines at these gaps. You see a lot of gaps here. Those gaps are certainly technically significant, and those are all potential targets. So I just laid them out there, and you can see those targets right there. With, I would say at this point in time, I probably shouldn't use the word max target. I'm kind of fluid. I don't have strong convictions on silver. Let me just say that. But max target, if I'm going to use that term right here now, would be about 1483. I'm been bullish, longer term bullish on the metal. So I like to trade corrections on the way up. My active trading account. But again, 1483. Why? Because that's a pretty big level there. Technically significant. You had two big reaction highs and a big gap right there, and you had some reactions around that level as well. So that's the potential. And again, I already gave you, if it doesn't go back down there, don't let it get away from you. It isn't an uptrend. Make no mistake about it. So that's why if you're short silver, you're shorting it as a counter trend trade. Here's your uptrend right here. So just looking for a pullback within the uptrend at this point in time. All right, next one up, Palladium. Palladium is an active trade on the site, an official trade, that means, if it's an active trade. And the other day I pointed it out that it was an objective add-on to an existing short or a new short entry. What we had, this is our primary trend line. It was broken here, and all that craziness after the big meltdown earlier this year. We kind of snapped above it on what I call momentum-fueled overshoot, but then we broke it again, and the fact it was a very impulsive selling afterwards validated that's still an important trend line, even though though it had been recovered. And so the other day I mentioned it as an objective short entry here on the back test, and had you done that, that's already good for about 10% gain in just a couple days. And the ETF that we use for that is PALL, Palladium ETF, and same thing. If you would have shorted it, that's where we were back testing on the futures. And the ETF itself is also down about 10%. I'm going to move this line down. You can see I have a line right here. Well, you might not be able to see it. Although now you can. So we're on PALL, and again, I'll look at both because the way I view it is some traders are trading Palladium futures, some traders don't use, they'll use ETFs, and so they're trading PALL. So if a certain subset of eyes or traders are watching, this chart, then that's only a potential trend line I'm putting there. Then they might step in. Now this is actually a support, so that's where I had a line before, and I'm going to add one close to it, and it definitely needs to be one here because here, I'll zoom in. There's a lot of reactions on this level, 177.64. So what we need to do, we need to see this level go. We have 1, 2, we had a little reaction there before we broke it, and then support once broken becomes resistance, and then we gapped above it, so that's technically significant as well. A lot of reactions there. So if you want to take the quick buck, if you shorted there the other day and we drop another, you could cover here, we're at the top of that support zone, but if we drop down to the bottom, that might give you another 2% or so. I'll probably get a reaction there on the gap backfill, but I told you my thoughts. This is a long-term short trade. I'm trying to capture what I believe to be as a major top. I think that was the end of the bull run in Palladium with a new bear market that's just in the very early stages with a lot more downside to go. We have a third target there at 125.20. We already hit our first two targets. And even if we just make it to that third target, you're talking about another 34% downside, and I very well may add additional targets to this one. And it all depends on a couple of things. Of course, first and foremost, how the charts of Palladium and Platinum futures look at the time, and then also how the charts of the stock market look, because that's going to reflect economic expectations. If the economy just gets going back on all cylinders some point this year, like the White House is trying to pump that. We're going to second quarter will be a little weak, and then we're going to be back to full. I think it was Mnuchin that said that the other day in the headlines, or yesterday. Whatever. Nobody knows where the economy is going to be. I have my thoughts where it'll be, and they have their thoughts, or anybody else has their thoughts, I should say. Where I'm going with this is as much of anything as a play on economic growth expectations, because it's been used in the automotive industry as one of the primary uses for Palladium and Platinum in emissions control. So point being, if we are only in the beginning of a recession that has more to come in the economy, in the U.S. and global economy, then you're going to see a continued decrease in demand for Palladium and Platinum, and those metals should fall. And Palladium had just gotten way ahead of itself. It had outpaced Platinum, Platinum, gold, silver, everything else. So it's just the nature of this beast. So again, a lot of potential downside, but we'll take it, day by day, month by month, and at some point, if we need to pull the plug on this trade and move on, we do. All right, finally, a couple others, and we'll wrap it up here. I wanted to point out, because I've covered the commodities recently, and been overall warming up, becoming more and more bullish on the ag commodities. But I do want to say coffee, it's not so good. It broke this uptrend line the other day. Let me zoom out a little farther and see what it looks like. But I wanted to point that out. That's not a good sign, so I wouldn't add right now. And this is that trend line that I had drawn there. So it is not the best defined, but there are at least four reactions, so it's worth noting. So we could see more downside in coffee. However, it still has that previous low from back in February right there. But the fact that it broke that near term is near-term bearish. You took out these reaction lows. We're probably coming right up on that one right now. And so what it does, it calls this very, and I think I might have said the other day, I'm averse to calling this an uptrend. Right here, it is an uptrend line, but the bigger trend is not, because we had an uptrend up to this point here, higher highs, right, with higher lows, but then we were making lower highs, and that's why I can't really call this an uptrend, but I can call that an uptrend line, if that makes sense to you. But the fact that we were, coming down here. So there's the bigger picture. Coffee needs to pop this downtrend line and ideally hold above those recent lows. It may want to make a run. Sometimes you'll see this where it'll just do a stop clearing move and then reverse. If it does that, I'll keep it on my radar and maybe add that on as an official long trade. So I just wanted to kind of point that one out. The rest of them look pretty good for now. The other, I'm not going to go too far. Yeah, I won't do the other commodities now. This video is long enough. I want to get out to you guys. We're just under the 30-minute mark on it. All right, I'll wrap it up here. And again, the levels to watch on the broad market, which way I think it goes today. Like I said, the redder the better if we get a red close today. And ideally then you get a, gap down or another follow through, some downside on, I was about to say Monday, but I believe markets are going to be closed for the holidays, so we're talking Tuesday. And that's the other thing too. The other thing, you have a 3-day weekend coming up. We've had, the markets are at multi-week highs right now, right? Let's go back to the S&P 500. Especially you look at tech stocks, Amazon, Apple, you look at the FANGs, QQQ. So here's the thing. How many traders want to go home with an extra day of overnight risk instead of 2 days overnight risk, 3 days? So I favor profit taken into the close. And, with the charts confirming that too, everything that I went over earlier, if you're not a day trader and you want to get your feet wet on trying to day trade, day trading, the way it's just swing trading and fast forward to me. And what you do is you take a much larger than usual position because you don't have overnight risk. So a day trade means if you usually trade, let's say $10,000 in QQQ, you could take $40,000-$50,000 in a day trade because you don't have any overnight risk. This is not going to gap against your position. You can keep much tighter stops than you would on a swing trade, and just ride it down. And then before the close today, whether we get that, hit that target, which is a little above 230, 220, what is it, 223, or remember, SPY may want to fill that gap first. So the first of either a backfill of these gaps, this is what a day trading target would be for today, the first of a backfill of SPY or QQQ gap. They're pretty far below. I mean, that'd be a big drop. That'd be a monster day trade if you're, short a couple contracts of NQ, ES. Remember, there's the micro contracts if you want to trade the futures, but you don't, NQ or ES is just too much money for you. NQ, each contract represents a short of about $187,000, whereas ES is about $146,000 short exposure to the index. And if that's too rich for your blood, then you just put a letter M in front of that contract. In other words, type in MNQ or MES, and those are the micro contracts. They trade off the same exact levels that I'm giving you here on these charts, except they use a smaller leverage factor. I'm trying to go from memory. I think it's 1/10, if I'm not mistaken, 1/10 of the size of the regular E-minis. So therefore, you're talking, on NQs, instead of $187,000, you're talking, about $19,000 exposure, if I'm correct on the leverage factor. And of course, you can look that up and verify it. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.